Again, we want to thank you for being on this call today with Sullivan Wealth Management, based in Bethesda, Maryland, which is an investment and retirement planning firm that serves businesses, business owners, and individuals in the D.C. metro area. Our title of our call today is Answers to Your Top 10 Questions on Investing, the Stock Market, and Planning for Retirement. On the call today from Sullivan Wealth Management, we have Chris Bailey, CPA, IAR, and Wealth Management Co-Manager, Paul Sullivan, CPA, IAR, Principal and Wealth Management Co-Manager, Ben Perrone, CPA, IAR, Supervising Senior Accountant and Financial Advisor, and Troy Patton, CPA, ABV, Portfolio Manager and President of Archer Investment Corporation. So again, we want to welcome everybody to the call, and I'll introduce my host and bring him on, Chris Bailey. Chris, welcome to the call.
Hi, thanks, Jeff. How's everyone doing today? I'd like to welcome you to the call. Just want to go over just a bit of the background behind this call. A couple weeks ago, we sent out a survey to all of our clients asking two questions. What would you do differently if you could tell a younger version of yourself something about investing? And also, what is your number one question regarding the stock market and investing? And we received an overwhelming amount of support from our clients. We had, I'd say, 50 or 60 responses, which really was impressive to us. So we thought that instead of doing our traditional annual call where we talk a little bit about the market and the update, we'll do that same thing, but in a bit of a different format, where we're actually going to answer your questions first and then cover any details afterwards that we missed in these 10 questions. So again, the title is The Answers to Your Top 10 Questions on Investing. Again, we had about 60 questions, so if any of you guys are out there with a question we don't get to, feel free, as Jeff was saying, to just ask it either via text or at the end of the call. So if we go ahead and move to the next slide. So again, this was the first question we asked all of our clients, and it was looking back to when you were younger, what is the one thing you do differently about investing or planning for retirement if you knew then what you now know? So if we go to the answer. So about 90% of our clients said pretty much these two words, start sooner. We got a lot of, no one told me when I was in my 20s and 30s that I needed to invest, and now I'm 50 and I didn't invest enough. Many responses like this. And I just wanted to bring this up to start the call off, because this is really why, and Paul can attest to this, why we started this wealth management department with Sullivan and Company, is because we are a CPA firm and we have a lot of small business owners and individuals who get to that age of 50 and 60 and tell Paul the same thing, that I don't what do? I don't have enough to retire. And the most we can do is to tell our clients that to start sooner. This is really the way to go. And if you don't do it now, there was a good response to don't start when you can afford it, because you'll never think you can afford it. But saving a little bit every month is the only thing you can do. Put a percent, put it into your budget, stuff like that. So, Paul, anything you wanted to add to this and your experience of,
I mean, we've been in accounting practice for more than 30 years, and we have many live examples of people who ended up in a very different place in their 50s and 60s than they wanted to. Some of them ended up being successful, and other ones, this happened or that happened, and now they're looking for retirement funds. So I would say that the question would be, what are the characteristics of a person that ended up successful? And if I had to pick the biggest thing, it was they saved something above zero every month. And many of them, if they had a 401k at work, they did a non-deductible IRA every year, even though it wasn't deductible. They did a debit to their checking account for, it doesn't matter if it's $100 or $1,000 or $5,000, but they did it every month. And so those people ended up in the positive side, and that's the characteristic that made them different. Anybody else?
That's it for me. We can move on.
Okay, Chris, the first question that we had that came in from the top 10 was, how much should I save if I plan to retire at a certain given age? And the note is that you had many questions like this.
Right. A lot of people ask, how much will I need in retirement? How much do I need to put away now? How is my spending habits? How do they have to change, et cetera? But that's kind of the big question, because when you're talking about retirement, you're talking about something that if you're working, you've never done it before, so it's a bit apprehension about, what do I need and how much is enough. And really, there's no real good answer to this question, because everyone is different. And the only way to really, try to answer this question is to plan. Plan for your situation. I mean, it all depends on, where you live, how big of a house do you have, is it paid off, how much do you travel, where do you go out to eat, what kind of car do you drive, how many kids do you have, how's your health. All these things come into play when trying to answer this question. And so what we've seen is really the only way to do this is an individual plan, one-on-one. We'd hate to tell you, you need $1 million. Well, that sounds pretty good. I hear in Indiana that's pretty good, and in some places in the country that's real good. In Montgomery County, maybe that's not enough for some certain people. So the real answer is financial planning, and I just want to talk a little bit about that, what that means for anyone who's interested. Basically, what happens is we would map out what you own, such as your houses, such as your bank accounts, your IRAs, retirement accounts, etc., and then what you owe, such as your credit cards and your mortgages and your debts, and then determine your net worth. That's the first step. What are you worth right now in April of 2017? And then project out in the future, what's going to happen. As Paul was saying, if you're saving $1,000 a month, $5,000 a month, $10,000 a month, what will happen given normal market conditions over the next 20 to 50 years, and will you be ready? And then you'll actually be able to see there, say you want to retire at 2025, how much are you going to have at 2025? Then if you maintain these spending habits, what about 2026, and so on down the road? So that's really the only way I can answer that question, is everyone's different, and everyone needs a different financial plan. Anyone have any other comments?
If you use a financial advisor that's not us, many of them don't do this. They, especially the ones that work on commissions or work on some other type of compensation, but not meant to be an advertisement, but we here, for tax clients, we offer a financial planning mechanism. It's basically a full plan for $250. And if you have investable assets with us over $100,000, it comes with the program. But if you didn't use us, your financial advisor should do it and should revisit it on an annual basis. And only then, because then changes can be made in the items that come up that you didn't plan on. But many people don't do, I would say most people don't do this because they kind of fear what the result would make them do. But it is something that the successful clients we've seen, they face it and calculate it and make that plan.
Anyone else?
Thanks, Paul. Thanks, Chris. Question number 2 is, when is the bottom going to fall out?
Yeah, this one, I laughed when I first read this one. But this is, we've been getting this quite a bit, given the current state of what you hear on the news and what you see on the internet and in magazines. So, Troy, do you have any comments on this?
Everybody, this is the $1 million question. When is the bottom going to fall out? And I would probably maybe just say, to put that into perspective, maybe another question would be, how far is this market going to rise before it drops? So everybody wants to know, when the right time to invest is. And the biggest problem with that is being that we all know that the market will correct at some point by 5 to 10%. That is going to happen. The real question is whether we go higher by 15% before we drop another 10% and then move higher again, and give the economy time to pick up some steam, to pick up earnings, and thus be fairly valued. So if we look back even into the 2000, 2001, 2002 era, and maybe even 1999 is a better perspective. But everybody thought, wow, the market's overvalued in 1999, and then the market continued to move higher and higher and higher and higher and higher. And everybody was correct. The market did correct. But then ultimately we did move higher than those 2000 high-level watermarks, just as we did from the 08-09 period. And although it's never satisfying to see the market correct 20%, if you believe that the United States is still going to exist, I would probably be willing to bet that the smart money would be on the fact that the that the market's still going to exist and that we're going to keep moving higher over time, if nothing else by merely the real inflation rate that may exist. So with that being said, and I'll address this a little bit later in some slides, but no one knows when the market's going to fall out. If we knew it was going to fall out next week, everybody would be selling today, even more so than the market is dropping a bit here today. So that's what I have to say on that.
Right, and
Thanks,
I guess the more long-term focus you have, I'm sure the better you can think about that. I mean, if you think about 20, 30 years ago, those of you in the market, we went through the 2000, the 2001, 2002, 2008, and we're all still doing much better. I think that's one way I like to look at that.
But Troy, isn't it, you just look at it, the people just need to temper their risk with the selection of investments. That's all. If they do that, then they're not as much at risk, and they don't, they wouldn't go down as much as if they were all in stocks or something. So it's a matter of us just tailoring the risk they want to take with that feeling.
Yeah, Paul, that's a great point. I mean, and really, I should have probably included that into what I was saying. That when we talk about when is the bottom going to fall out, most people are referring to the stock market. The reality is most people should have a moderate type portfolio. Even my own investments are a moderate type portfolio. So if the stock market does decline, as it is even today, bonds are actually increasing. So it helps to offset some of those gains, and it helps smooth out those returns over time. And that will also help you sleep at night, knowing that you're well diversified and that the market is going to have its own gyrations, just as every market will, whether it be commodities, gold, bonds, stocks, etc. But having a good, well-balanced portfolio will help you smooth out those times and sleep comfortably. So. And
that's historically happened, Troy, too, hasn't it? It wasn't in 2008 bonds actually did okay when the stock market was crashing?
Yeah, well, there were certain areas of the bond market that didn't, but overall, I mean, the long bond continued to improve, and we've really seen one of the longest bull markets in the bond market in the history of all the markets combined here over the last 20 years. But there were some areas of weakness in the bond market, typically in the high yield sectors, and although you may have some exposure to that, the majority of the exposure, at least in the portfolios that we manage, is typically in the investment grade corporates. So.
Right.
Thanks, Troy. Thanks, guys. Question number 3, how to determine and balance my risk profile. As an entrepreneur, I am optimistic about the future and spend much less time worrying about my own welfare as opposed to those companies that I manage. I need to have a system that advises and assists in managing that risk, but requires little of my constant direct attention.
All right, so when I read this one, I really thought, this is an example of what many of our clients are small business owners, and they have this exact same problem, is that many small business owners are very busy people. It takes a lot, to run a construction company. It takes a lot to run a law firm. It takes a lot to run a restaurant. It takes a lot of time, it takes a lot of energy, it takes a lot of knowledge to do these things. And really, all that energy spent doing that and obviously worrying about your family and other stuff, you don't really have the time to check up on the market every day, to study it like a professional does. Really, the answer to this is to have a good manager for your investments. You pay a professional that spends all day looking at this stuff, instead of you who has a lot of other things going on to manage your money. And that is really what we've seen our clients have the most success doing. Again, we recommend Troy, but any good manager, that you have is going to do a great job for you if you have the trust and if you stick with them. Whoever asked this question, I mean, really active management is really the way to go. Anyone else have anything to say about that?
We've had clients before that own their own business that trade in the stock market. We're kind of for someone, if they want to learn about the stock market and investments, to have for example, a side fund, a small amount of money that they can lose if they want to get exposure. But inevitably, if they do it too much, they can't pay attention to their business. And if they're in the whatever industry it's in, they are busy at their desk trading stocks when they should be paying attention to their own business. Your own business you have a much more control over than you do in the stock market. So if you're going to be a business owner, you should be managing that business, and your return can be much higher rather than managing your own investments. And we've seen people fail in this area.
Another good thing about having that manager is, and kind of relates to the question number 2, when's the bottom going to fall out? It's a lot harder to, trade your stocks and lose money in a time like 2008 or 2001, 2002, and stick with it. A good manager, when you're going to pull out, he's going to, give you a call and talk it through and maybe be there for you and explain what they're doing and say they have a plan to get through this. It's much harder to do that when you're picking your own stock and you're dealing with that emotion of, I did this and I need to change it. A lot of times that results in selling that you don't want.
Okay, next question. Paul, number 4, my biggest question would be, is there a benefit in the long run in picking individual stocks, or after all is said and done, is just buying various funds that are in a variety of classes a better way to go?
I mean, I've seen people have success both ways. They shouldn't be really managing their own individual stocks other than a small fund, because they can't research them, they can't follow them. So whether you pay an advisor or you pay a mutual fund manager to manage the stocks, in general, that's a better way to go. We see individual stocks in general, over time, most people lose money. We see losses, and people have large carryovers from investing in individual stocks that they bought on a tip or something. So we would say it's better to do through a mutual fund or an advisor for their retirement plan and main fund.
Sounds good. Question number 5, what is the most advantageous system for withdrawing funds during retirement?
Well, the best way to do it is to use the retirement funds last if possible. The reason why is if you have money in an IRA or 401k, when you take the money out, you pay tax on the money you take out. So it's best to use, if you're getting Social Security, which most retirees are, or if you have cash saved up, or other investments that aren't in IRAs or 401ks, to use those monies first, and again, have the plan, have the financial plan. What is this dollar for that I have saved here, and if possible, take that money out last. Any other ideas on that?
Okay, Chris. Question number 6. How can one avoid the temptation to hop around and follow the latest fad?
Troy, I know you've talked about this in the past. Do you have any comments?
Yeah, so I think this is a great question, and that somebody asked, but this has been studied numerous times by Dalbar, Morningstar, all kinds of different groups, and inevitably, those folks who chase the latest and greatest, or the latest 5-star fund, or the latest fad. I mean, I remember when oil was at 120 and Goldman Sachs said it was going to 200, and then people started piling into oil, and sure enough, now we're back in the 50s, or low 50s and sometimes 40s. Inevitably, it's not necessarily the idea of chasing, or we don't want to chase yesterday's fad or the current fad. The idea is slow and steady, and the key there is steady wins the race. The average stock investor, and this is done by Morningstar, and this kind of goes with what Paul was saying on the last question. For instance, if the average return of the S&P 500 over the last 20 years was 8.5%, the average return by the average stock picker, or the person who tried to pick and move investments around, even in mutual funds, was actually about 3.7% average annual return. That's a huge, it's less than half of what the stock market's returned. And the reason is because, like the Washington Nationals, I hope Bryce Harper has a great year. I think he's a great baseball player. And I'm sure if the Washington Nationals do well, that everybody's going to go out to see them, or the Baltimore Orioles. But the reality is that's really when you probably ought to be selling your season tickets. you have to have a little bit of a contrarian view. When the Washington Nationals are doing poorly, you're 1 year closer to having a winning season. That's the way you have to kind of look at it. And when that season's done, well, you're 1 year closer. It took a long time for the Cubs to get there, but in the stock market, it happens a little more frequently. The average turns in the market cycles are a little more frequently than 101 years or 99 years. 108 years, yeah, whatever it was. So I would tell people that, again, slow and steady being the key there, wins the race, and being invested over time is essential as opposed to moving investments around. And I'm talking even with the money I invest myself, I do the exact same thing. I try to just stay steady, put it away, and keep saving. So.
Thanks, Troy. Anybody else? Okay, question number 7 was, how do we plan for the near future and extended future with all the turmoil in the world today? Chris?
Right. For this, Troy was mentioning before a little bit about, the U.S. being undefeated in comebacks, and if you have faith in the country and you'll have faith in the market, that eventually that market will be there in 20 and 30 years. Another good way to look at this is you got to remember that, the world, there's always going to be turmoil in the world. There has been probably since the beginning of time, but you're really investing in companies, and you're investing in companies that make money, companies that people have reason, to buy things with. I can use this example. 3 of the biggest companies Troy invests with are Starbucks, Microsoft, and Disney. So Starbucks, people are going to go buy their coffee and buy their cakes and everything. Typically, that's something we believe people are going to continue to do. And when they do, if you're invested with Starbucks, you're going to make money, regardless of what you hear on the news of what's going on in the world as far as other stuff goes. Microsoft, we're sitting here using Microsoft PowerPoint, Microsoft Excel, Outlook. Every single day, businesses are still buying Microsoft products. And Disney, they're putting out movies, opening amusement parks, all the time, and people are still going to watch those movies to be entertained. So those are just 3 examples, and obviously there's many, many more industries we're in, but it's really important to remember you are investing in companies. You're not investing in the state of politics or the state of one thing or another, and that maybe makes you feel a little bit better about it. Anybody else have something to add?
Sometimes if you look at it from a larger lens or a bigger picture, rather than focusing on details of what the news is talking about, you can understand that you're investing in good companies that are making money, and you should take a look at their financial balance sheet, their income statement, and that will tell you how the investment is, not necessarily what the news says.
Thanks, Paul. Anybody else, Troy?
Yeah, let me add 2 cents here. Paul, and I think you probably remember this, I'd say about 3-4 years ago, I came and did a speech, and we had a seminar there in Bethesda, and we were discussing the stock market, and everybody was worried about Greece because the news was saying that Greece was going to spread throughout Europe, and it was going to collapse the entire system. Can anybody remember that at this point?
1 year ago was Brexit, right?
You're right.
That was the big thing.
That's the only, I just remember that being the key focus on everybody was, Greece is just going to bring everybody down, and it never did. So that's all.
Thanks, Troy. Question number 8 was, what do you see as the future of passive investing?
Let's kind of explain what this person is asking for some of you on the call. So there's a couple schools of investing. One is active and one is passive. Passive would be as if you buy and hold. You buy, for example, an index fund, an S&P 500 fund, which is the top 500 stocks in the country, publicly traded companies, and you just kind of let it go. Let it do what it does, and over time, hopefully it'll be higher. The other way would be active managing, which is what we recommend, which is buying several mutual funds and in a variety of classes and investing as to how the market condition is now. So Troy, do you want to kind of take that as to from here what do you see as a future of passive investing?
Yeah, I think passive investing is going to continue to grow over time. I think it's a very simple way for people to invest. I will say this. And obviously I'm biased because we do active management with our own funds. However, as a firm, Archer Investment Corporation, and the portfolios that we manage, we use both active and passive because there are categories in passive investing that don't work very well. One of those is foreign. Another one is bonds. Sorry about that. I don't know what happened there. Foreign, bonds, small cap, mid cap, any of those type of areas, it is very difficult to be a passive investor and outperform a certain indices. The other thing I would also tell you, and it's been proven time and time again, that those managers that eat their own cooking tend to outperform. In fact, by a margin of about 6 out of 10 that invest in their own funds they manage outperform over a 10-year period of time. And I would tell you that that's where we fall in. I mean, we fall into that same camp. We put our own money where our mouth is, and we believe that if it's good enough for our clients, it's good enough for us, and that's the way we should be investing. You have to also remember that there's a lot of folks who invest in a lot of active mutual funds that are sector-based. So they may be based on, they may only invest in financials, or they may only invest heavily in financials, or frankly, they may invest in the S&P 500, but do it in a different way. And let's say they carry some type of management fee. Maybe they don't outperform the market. It's possible that they don't, but it's possible that they never intended to because of how they're set up. For instance, they're really index funds cloaked in an active management style. That's becoming more and more prevalent. So I would tell you that we believe in both. We think there are excellent passive index funds, and we think there are excellent active management funds. And when we combine our portfolios, we try to take the best of both worlds and combine those into our portfolios.
But there was one question related to that. I don't know if Chris is going to do it later, but it says, why would anyone ever try to guess which individual stocks are worth betting on when a portfolio of index funds beats the genius stock pickers a majority of the time? What would be your take on that, Troy?
Yeah, that's actually not true. That's actually just promulgated by companies like Vanguard, which I think are great funds. I mean, and great index funds. But let me just give you a good example of Polaris Global Value or someone like that. How is it possible that those guys have been able to outpace over a 3, 5, 10, 15, and 20-year period of time the active managers, or excuse me, the passive indices, and they do it on a consistent basis? Those are the type of folks that we try to invest in. We want to invest in those people that over time, and a lot of times when they say the genius stock pickers, they're actually referring to the hedge fund guys, the icons of the world, and people like that. I got to tell you, I don't think those guys are that genius. Yes, they do really well in certain periods of time, but they also do very poorly in certain periods of time. And in my opinion, if you want to invest in the index, then you're just basically guaranteeing that you will not perform up to the S&P 500 by whatever expense level that fund charges. Even if it's minimal, by 0.05, 0.06, 0.1, 0.2, it doesn't matter. You're still going to underperform by that amount. And then furthermore, the other thing that I would say, and probably this is the most important thing that I would tell everyone on this call, is that it's not every individual, in fact, hardly any individual should be investing in 100% stocks. Because just as I mentioned before, with Morningstar and Dalbar talking about how the average stock investor performs who invests in mutual funds and stocks, those people underperform by more than 50% because you think you're aggressive until the market gets aggressive with you, and then you end up selling. And the thing is, when you sell, you have to be right twice. You got to know when to sell, and you have to know when to get back in. And the best index investor is somebody who can put it away in the S&P 500 and then wake up in 30 years and look at it again. And I will tell you this, 95% of the people in the universe cannot do that. They look at their statement every single year. So,
a lot more than every single year too.
About that.
Maybe every week.
Yeah.
Thanks, guys. Question number 9 was, how can I be philanthropic while saving for my future?
So I think what this question is asking, at least the way I understand it, is how can I give to the causes I want to support while I'm also saving for myself and investing for myself? And I think it's a very tough question to ask and tough question to answer. Because it's a very personal, emotional question for a lot of people. Obviously, we cannot give as much as we all want to give. There's no one person in the world, I think, has the means to give enough to make everything in the world right the way they want it to be. So really, the only thing you have to say no sometimes. It's okay to say no when people are asking, for your time and your money. You just don't have unlimited resources. So I guess that's where the question comes in. How do I do both at the same time? And I think it all comes back to budgeting, really. When you set out in your budget every year or every month, I'm going to give, if you're starting out, 1-2% to this cause, this cause, this cause. I'm going to give $1,000 to this person, $1,000 to this by the end of the year. And then when you accomplish that at the end of the year, if you do, you feel a lot better about it because there really would be no end to it if the only thing you could be is philanthropic. I guess another thing is when you invest in yourself, you actually are investing in everything you believe in. You are not going to be able to help the people you want to help and give to the causes you want to give if you don't pay off your house, if you don't pay off your credit cards, if you don't have an IRA, if you don't have any retirement. You'll never be able to do all those things to their full extent. So in some ways, paying yourself now, really does pay the causes you want to support later. Anyone else have anything to chime in?
Okay,
right.
Thanks, Chris. Question number 10. What is a reasonable retirement budget as your lifestyle changes after retirement?
And again, I think this goes back to one of the first things we talked about is you really just got to plan for it. And everyone, again, has their different budget. And you have to do your own individual budget, monthly, and then you're going to have to see, what's going to change in retirement. There's a rule of thumb I heard, and maybe Troy and Paul can talk about this more. I've heard of something about 75%, is about what most people need, 75% of your earnings while you're working when you retire. But again, that's just a rule of thumb. It depends on, how you want to live your retirement and go about your life. Anyone else have anything to add? All right. So that's the last of the questions then. At this point, we're going to open it up to everyone on the call, and the instructions are there on the screen if you have something to add.
Thanks, Chris. Again, if you have a question, we've opened up the lines. Just go ahead and start talking if you do have one. If you're on the webcast, you can ask your question by submitting your question there in the submit your question box. Just press the submit button after you type it in. Lines are open. Any questions?
Yeah, I have a question. I was wondering, what are the standard investment fees that you guys usually charge?
I can take
Good
that.
question, Chris.
What do other people charge?
What do other people charge?
Or what other people charge.
Oh, right. Compared to what other people charge. So
yeah.
The way we invest with Archer Investment Corporation is we have an active management fee. We're a fee-based investment company, and the fee is 1% of assets per year, and then it's 0.75 if you have over $500,000, and then 0.5 if you have over $1 million invested with us. So let me explain what that means. So let's say you have $100,000 invested with us. The fee throughout the year will be $1,000 each year if you have $100,000. So the idea is, you pay a $1,000 fee, and hopefully the investments make 7 to 10% a year, maybe. So you come out on top. The alternative, really, what we see is commission-based fees, and commission-based fees would be, let's say you invest $100,000 into one fund. So the broker then would invest the money, and the commission could be, say, 5%. So then out of the $100,000, you're down to $95,000. Okay, and then after that, the manager really doesn't have much of an incentive to keep helping you because he's made his money. Where as opposed to in the fee-based way, like we do at the 1% or 0.5% a year, we are going to be in it for you, because the more money you make, the more money we make, and obviously the more you keep coming back to us when we make you more money. Does that explain it well? Anything else from Troy and Paul on that?
Only that we see quite a lot of people on the accounts under 500,000 and some above it, but under 500,000 we see the sale of A funds, which carry a 6% front end. So
right. I use
we've
5, but
seen
some of these are 6%.
situations where people will put 300,000 in, and it would immediately become 280. The brokers argue that it's cheaper because that's all you pay. I don't know how you can switch, because if they switch you, you're going to have to pay another. They'll switch you to another A share.
So yeah, the more you trade that way, the more money it costs. Whereas for us, the trading, we will trade, and Troy can attest to this, based on how the market is. So at any point we can make, we can rebalance it or put the money in a certain fund that we think's better, given the conditions of the time, and it doesn't cost you anything extra.
Okay.
Yeah.
Thanks, Chris. Other questions on the phone?
Yes, I own a business and I want to save for retirement. I also have 2 employees. So what type of retirement plan should I pick for my small firm?
Good question. Chris? Paul?
Yeah, we can talk about that. There's a lot of small plans available for small businesses. It could be a simple plan, a SEP, 401k. There are a lot of different options. The one thing a lot of business owners, it sounds like you're kind of concerned about maybe the cost, of the plan because you have employees. So yeah, in general, when you have a retirement plan at your business, you are going to have to put money in for your employees to some extent. But usually the tax savings, we can talk about this, I don't want to talk about this in public, but usually your personal tax savings would by far outweigh the amount that you're going to have to put in for just 2 employees. So say these people make, say, $50,000 a year, and say, that's times 2, that's $100,000. Say you had to put in 3%. Say in a simple plan you put in 3%, right? So out of that $100,000, it's going to cost you $3,000, for the employees, whereas you could put in probably $20,000 around, give or take, and save $6,000 to $10,000 in tax right away. So, your tax savings right away probably are going to outweigh the amount you got to put in for your employees. But yeah, so the answer is probably a simple IRA, if not maybe a 401k for your business.
All right. Thank you.
Mm-hmm.
The simple IRA is a pretty easy solution because there's no cost. So many situations where companies have employees under 40, they don't want to participate. You have to match 3% for any participating employees. But even if you do a match, it doesn't end up being a lot of money. If somebody's making $40,000, 3% is $1,200. You match $1,200. It ends up being $100 a month. So it allows the owner to put in $13,000 to $15,000, depending on their age. And the biggest characteristic of this is, when you get up in the years and you're 50, you can't go back and put it in later. You have to put it in for that year. So the people can't catch up. There's small catch-up provisions, but they're not enough. So if you're 50, you can't go back and put in for the 10 years. So if you miss the opportunity, and if you put in $15,000 to a simple IRA, you save $5,000 right away. It's tax deferred, and it does grow, and you still have the money, essentially. So that's the biggest characteristic of people when they get older, if they haven't provided in those years. And in general, they're not going to be able to retire on their simple IRA contribution. That's going to aid it, but they're not going to be able to retire on the savings of $15,000 a year. If they want to put in more, they can. If they're above 50, they can put in $24,000 a year. But even that is not going to fund their retirement. It's not going to be enough. So if they don't do that at a minimum with the tax savings, that's going to be a big part of the retirement plan failure if they don't do that small amount. In addition to that, they can always get an IRA, husband and wife, if their company doesn't have a plan. The business owner that just asked the question can always do $5,500 under 50 each, which is $11,000. They save $4,000 in tax. They can always do that without their participation of their company.
Good answer. Thanks, Paul. I see one more question on the phone lines. The line's open. Go ahead and ask your question.
Yes. Can I put into an IRA if I make over a certain limit?
The answer to that question is yes. Anyone with earned income under the age of 70 and a half can contribute to an IRA. What you may have heard about is if you make over a certain amount and you and or your spouse are covered by plans at work, you may not be able to deduct the contributions. So I know I said a lot there. So anyone under the age of 70 and a half can contribute to an IRA. Most people can deduct it. However, if you make over certain limits, you cannot deduct it on your taxes, but it's still worth putting in. And the reason for that is, so let's say you put in, $6,000 to a non-deductible IRA is what we call them. You don't get to deduct it now, but the $6,000 is going to grow, hopefully, throughout the years until you take it out. And if you had it in normal stocks and bonds or even in a cash interest earning account, you'd have to pay tax each year on all these earnings. So if you do make over the limit and you put into a non-deductible IRA, your IRA will earn money each year and you will not be taxed on it until you take it out. And that's something, and Paul can talk about this, we really encourage all of our clients that are in that high income bracket to certainly do. I mean, non-deductible IRAs are, we think, one of the most underused vehicles out there for investing.
That's correct. I mean, the smart people we see, they put in the max to the 401k, and on January of each year, they put a non-deductible IRA in on January 2nd for $6,500 or $5,500 for that year. And even that is not enough, but it is a very good habit to get into. If they don't do that, they do a automatic debit to the personal bank account for their IRA.
All right, anybody
Thanks,
else?
Paul. Thanks, Chris. Any other questions? Or I know, Paul, you said we had a lot of questions. Any other questions that didn't make the top 10 that you guys want to address? Because I think if we don't, then Troy has got a little bit of a discussion he wants to talk about.
Well, that's all I wanted to talk about was these 10. If anyone else, Paul, had anything else?
No. Proceed, Troy.
Yeah.
Okay. I just a couple slides here. I'm gonna jump through these real quick because I know we're probably short on time. One of the things I really want to talk about, and this is, when is the bottom going to fall out? And somebody had, sent in that question. Well, clearly the market's pretty, I would say, maybe a little more than fairly valued. We're up towards above that 25-year average. We're a little bit over that, obviously, on the forward PE scale. But again, we're also looking at very low interest rates. And those low interest rates are obviously is what's driving this market higher at this point, as well as the prospect that maybe we'll get an infrastructure spending bill as well as a tax break. Now, obviously, we've already participated in the market from that standpoint. So the question is, when is the bottom going to fall out? Well, I will tell you this, if you want to jump to the next slide, Jeff, is that the bottom doesn't necessarily have to fall out. You can see where we're currently at in terms of the stock market of the forward PE and then the subsequent 5-year annualized returns as well as the 1-year returns. It doesn't necessarily dictate that the market's going to move lower from this point. In fact, it very well may move higher, albeit maybe at a slower pace than in the past. But it is there's a lot of potential that it may move higher. If you want to go to the next slide. Again, this is just showing that we're up in that 10th decile. This is the S&P 500 PE on trailing 12-month reported earnings. And again, we're over that 90th percentile. And that does worry me. In fact, if we did see a decline in the market, I would say it's going to be to the tune of about 10 to 11% at this point. Until we catch up further, we're going to give back a lot of those gains that we've received since the election. But with that being said, if we jump to the next slide, we're also in a phase of where the interest rates are being we're seeing a rising interest rates. The Fed's been raising rates, and in fact, we've just seen the second interest rate increase by the Fed. Typically speaking, the market still performs very well even after the third and fourth raise. So there are we do have some time to go here. I don't think that the market is frankly whether overvalued or undervalued in some regards. And if you want to go to the next slide, Jeff, and this is actually my last one, I think this is the most important one. Our forward earnings yield as of February in 2017 was about 5%, and the yield on the 10-year Treasuries was about 2.45. It's obviously less than that now. And typically is what history tells us is when the 10-year in this market, when the earnings yield is at 5%, once the 10-year gets to 3.6%, we generally will not see the stock market grow anymore until we see very solid earnings growth in those companies that make up the market. So with that being said, one of two things is going to happen. Earnings are going to continue to increase, which we've actually seen over the last several quarters. In fact, if we look back a year ago, 1.3 companies to 1 is actually increasing their earnings over the same period last year. That's a little bit under the average, but it's getting closer to the average, and it's been doing better and better each quarter. And I really believe that we will continue to see increased earnings out of the major companies here in the United States. So if I believe that, and I believe earnings are going to continue to move higher, so that forward earnings yield would actually probably tick up even higher, we really would have to have that 10-year get much higher and higher. So it's very possible that this stock market moves over the next 2 years about 30% higher. And you say, Troy, that's crazy. It's really not that crazy if you think about it. The reason is, if interest rates stay low at these levels where they're currently at, borrowing is very inexpensive, as most of you know. And typically what happens is these companies, their earnings are now no longer predicated on what interest rates are doing. It's really about more what they can do in the economy. I don't care which side of the aisle you sit on from a political spectrum, but if they do ultimately reduce the tax rate on here in the United States on corporations, we would see companies like Kohl's and some of these retailers that have really struggled, as well as the financials that are based here in the United States that get a lot of their income here in the U.S., really increase. And those increases would put that forward PE number well below that 10th decile or top 10th decile. And in fact, it would probably spur a lot of economic spending, and as well if Washington can pass it along with an infrastructure bill, although I was listening this morning, they said this is probably going to get tabled until 2018, and I believe that's one thing that's obviously weighing on the market, as well as maybe some comments out of Russia and Syria. But with that being said, I do believe that some tax bill, some infrastructure bill will get passed, and therefore the market will move higher. And the reason is because, frankly, there's going to be a lot more spending, and then local governments will piggyback on that Washington spending to issue more bonds at a lower interest rate, which will increase additional spending at the local level and thus spurring economic activity. We've already seen some of this in the manufacturers index, or it's what's called the ISM, and that's the manufacturing index report. And anything above 50 means we're at expansion. Anything below 50 means we're basically detracting. Okay, and we're running around 55 right now on the ISM, which is very positive. We have not seen these levels in quite a while. And I do believe that this is going to spur the economy even further and thus create additional gains. With that being said, I'd like to recall just what we were talking about with Paul earlier, that it doesn't mean that the market can't correct 10%. Okay? Don't mistake what I'm saying when I say the market's going to move higher by 30% possibly over the next 2 years, maybe even 2.5 years. It's very possible that the market moves lower and then higher, or higher and then lower. One of those two things I'm pretty certain is going to happen. Okay, I mean, so what I would do is I would take more of a diversified stance, and that includes passive and active investing. and just as we spoke about earlier, and that way it smooths out part of that ride. Okay? So with that being said, that's really what I have in terms of notes on the market, because everybody always likes to know what's going on in the stock market, and I think these quick graphs that I showed are fairly important. Anybody have any questions for me?
When you have on there forward earnings, I think I know what that means, but why don't you explain what it means?
Okay. So basically, let's say I have company A, and I made $100 this year, and my stock price is trading at 1,000. That means I'm trading at 10 times earnings. But let's say next year I expect to make $200. Okay, that my forward earnings is $200, and if my stock price is 1,000, my forward PE is 5. My current PE is 10. And typically, I believe in always reversion to the mean, and which means about 16 or so in terms of a forward PE, and we're at 17.7. But I do think if we get a tax bill passed, obviously that's going to help, and therefore it will put our median forward PE at a much lower number, which then the market can continue to rise higher. I don't know if I explained that very well or not, Paul, but I mean.
Well, if the stock price is 100 and you earn $5 a share, that's the 5% you're talking about. Is that correct?
That's correct. Yeah.
Right.
That's the earnings.
So
yield.
that earnings that's the entire stock market?
It is. That's the this is the S&P 500.
Oh, the S&P. Okay. So
yeah.
that's the 500 companies. The average stock price was 100. They're earning $5 per share.
Yep.
Which is their yield, 5%.
Correct.
Right. What do you say to people that say the PE is too high now?
Well, I would say I'd agree with you. The PE
right,
it is higher than the norm or the average over time.
Uh-huh.
I'm sorry. Go ahead, Paul. Were you want to say something?
Well, that's what we hear. People emotionally don't participate because they say the PE is too high. It's going to be a correction.
Yeah. So one of two things are going to one of two things are going to happen. Even earnings are going to continue to increase, which I would bet that's what's going to happen because that's what's happened since the history of the United States of America. Or you can believe that the stock market's going to fall, and that doesn't always happen. And in fact, over time, that has not happened. That the stock market has actually continued to increase, and the reason is earnings continue to increase. So it's really 1 + 1 = 2 in this case. And if earnings increase, the stock market's going to move higher, and that PE is going to move lower, and then ultimately the stock market will move higher once it catches up to it, and it will catch up. It's either going to catch up through two things. If we get no tax bill passed, an infrastructure spending bill out of Washington, this market, I would guess, will correct about 10%, and then will be about fairly valued, somewhere right around there. Maybe even 12, 13%. Then the market will be fairly valued, and you should invest all your money. Or number two, they will pass something, or possibly maybe the market doesn't correct and they don't pass something. And then, frankly, your average returns over the next 3 years, I would guess, are going to be about 5 to 6%. On your investment accounts, which are going to be higher than your bonds anyways. Okay? Or number two, nothing gets passed, and or excuse me, that was my example earlier, correct? I lost my train of thought there. Or something gets passed and the market moves higher because obviously earnings are going to be much higher. So.
Okay.
Thanks, Troy. Thanks, Paul.
Okay.
Any other comments or questions, Chris? I know you wanted to say something here.
Yeah, just wanted to wrap everything up. Thanks, everyone, for listening today. Just wanted to kind of wrap up and explain what it is we offer here at Sullivan & Company and through Archer Investment Corporation. We are investment advisor representatives, myself, again, Paul and Ben, who's been on this call. We represent Troy and his team at Archer Investment Corporation. They're active managers of investments, and again, they're the best investment company Paul's seen in over 30 years of doing business and accounting. We encourage everyone to invest. If you invest with your own good advisor, that's great. If you'd like two things, we can offer you. Number one, if you have an outside advisor, that's not us. We offer a free second opinion where we analyze your investments and offer suggestions to improve it if needed. A lot of times we look at some certain portfolios and say, you're doing great, stick with this guy. And a lot of times we also see some problems, some of the problems we were talking about before, such as the high fees or commissions, stuff like that, or not allocated, with stocks and bonds. It's too much in stocks or too much not in stocks, something like that. We offer that free to all of our accounting clients and all of our tax clients. Just send us in the statements, talk to me, Ben, or Paul. You see my email address there. And for those of you listening, it's cbailey@esullivan.net. That's CBAILEY @esullivan.net. And our phone number is 240-800-4300. That's 240-800-4300. And if you want to get started, if you're not investing, really that's the main reason we're here, is to help people that don't have anything, that have not started this yet. You can call or email me as well. Anything else to add, Paul?
Well, the reason we offer that second opinion is because over the years we've used to refer it out, and we've seen our clients be abused by other financial advisors. That's why we took control, and we do it now. It's not to actually sell you what you're doing. It's actually just to give you an independent opinion, so that when you turn 60 and we're still your client, that you're still our client, that we've at least told you and given you some independent advice of where you stand.
Yep, that's all I had. Anything else to add, Troy, Paul, Jeff?
Nope, I think that's good.
Thanks, everybody.
If anybody in the audience needs follow-up, you're welcome to call us.
Thanks, Paul. And again, we
Alrighty.
want to thank you for attending, well, whether you were live or even on the replay. Again, this has been answers to your top 10 questions on investing, the stock market, and planning for retirement. If you do have a question, again, the way to get a hold of the Sullivan Wealth Management is by calling 240-800-4300. That's 240-800-4300. Or you can visit their website at esullivanwm.net. That's esullivanwm.net. Again, thanks for everybody at Sullivan Wealth Management and Troy for taking time, and we will hope to talk to you soon. Bye now.
Thank you.
Bye.